Hey guys, Lincoln here from BoAcademy.org. Today I want to talk to you about stocks. What are stocks? Why they exist? How do you buy them? What the risks are? And how you avoid losing your money. There's a lot that we want to cover on this channel moving forward. But before we can get to all of that, we have to first establish what we're investing in, right? The stock market is all about stocks. Investing in stocks, understanding the companies that you invest in, and how you can make returns on your money, right? And avoid losing your money. So there's a whole lot we want to cover, but the foundation is understanding what a stock is, why they exist, how you can buy them, and what the risks are. So in this video, we're going to cover exactly that. And once we establish what a stock is, we will have all the information we need to move forward with more fun and more complicated ideas on investing in the stock market. So let's get to it and let's learn what a stock is and why you should be invested in it. So what is a stock? A stock is just another name for a share of a company. If you own stock in a company, that means that you own a share of that company. So public retail investors like me and you most likely own common stock in companies that we invest in because that is the most accessible form of a stock on the stock market. Common stock is a security that represents ownership of a corporation. As a common stockholder, you own part of the company, so you are entitled to voting rights in key decisions. You get to elect the board of directors and you get to vote on major corporate policies. So you have power as a shareholder, as a stockholder. So why do stocks exist? I covered this in a previous video on the initial public offering, the IPO process, so you should definitely check that out. But in summary, stocks are issued by companies to raise funds in order to cover expenses needed to grow the business, right? So a company goes out there to investors and offers them shares in their company in order to raise funds from those investors that they can use to grow the business. And in return, as shareholders of the company, investors get to vote on major decisions that will affect the future of the business. So after the initial public offering, after the company has sold their first batch of shares to the investors, they can go on to raise more funds from investors by issuing more stocks onto the market. And they can do this at any time they want, but they usually do it when they believe that the stock price is currently valued favorably for them. The higher the stock price, the more the company can raise from investors when they issue more shares, more equity onto the market. So why should you invest in stocks? You might want to invest in a company's stock because you stand to benefit from the appreciation of the value of that company on the market. As the value of that company increases, so does your net worth, because you own a portion of that company as an investor in their stock. On average, the returns from the stock market far outpace inflation at 2%, and any returns that you stand to gain from interest on your savings accounts in any bank, right? These banks pay you anywhere from 0.01% to as much as 2-3%. So that is why you would invest in the stock market, because again, you get to benefit from the appreciation of the assets that you hold. You also stand to benefit from distributions of earnings from the company. So when a company makes money, they might choose to distribute part of that money to their shareholders in order to incentivize them to continue to invest in the company. We will discuss this more later on, but that is another reason you would choose to invest in the stock market. Of course, you can also lose money by investing in the stocks of bad companies or not understanding the nature of the industries that you invest in. We'll cover this later on, but for now, keep that in mind. So where can you buy stocks in the United States? If you're a retail investor like myself, you can buy stocks that are listed on public stock exchanges, such as the New York Stock Exchange and the NASDAQ exchange. The New York Stock Exchange is the largest stock exchange by market cap in the world. In order for a company to list its stock on one of these stock exchanges, it must first go through the IPO process, which I covered in another video that you should definitely go and check out if you don't know what an IPO is yet. Once a company's stock is listed on one of these public stock exchanges, investors like me and you can buy and sell these stocks at the market value. So here's a fun fact. The first ever common stock was established in 1602 by the Dutch East India Company and introduced on the Amsterdam Stock Exchange. So now let's cover how the price of a stock is determined at any given time. The price of a stock is based on its market supply versus its demand. If more investors want the stock than there is supply for the stock, then the price will go up. And if there is more supply of the stock than there is demand for the stock, then the price will go down. Because the supply of the stock doesn't change often, the price of the stock is mostly dependent on the demand for the stock. And demand is mostly influenced by the public's perception of that company at any given time. So if there is good news about the company, then more people might want to become holders of the stock for that company. That means that they will bid to buy the stock, which will cause the price of the stock to increase. But if there is bad news about the company, the current shareholders might want to sell their stocks to other investors in order to avoid losing money on their investment. This can cause the price of the stock to go down in the short term. So now let's cover dividends. As a shareholder of the company, if the company decides that they want to distribute portions of their earnings to shareholders, then you are entitled to your share of the distributions. These shareholder distributions are called dividends. Dividends are considered income, so they will be taxed accordingly. Finally, dividends are usually paid out each quarter or every other quarter. But not all companies issue dividends. Dividends take money out of the company and leave less resources for the company to reinvest in its growth. For that reason, some companies opt to not pay out dividends because they want to continue to reinvest in their growth, especially when they are young and still growing. Some companies that you might have heard of and that are big but don't pay out dividends are Amazon, Google, Facebook, or Tesla, right? These companies are big, but they're still growing and they want to continue to invest in their growth. They want to continue to capture more and more market share so that they can build a more sustainable company in the long run. As an investor, you need to understand your own goals. For me, I want to see my companies reinvest their earnings into the business in order to continue to grow. Because as they grow, the value of my stocks increases, and that means my net worth also increases. And as my net worth increases, so does my access to more capital that I can use to invest in my own ventures or buy assets such as real estate, because banks will be more willing to lend me more money because I have a higher net worth. For those reasons, I don't like to invest in dividend paying companies, because if they're paying me dividends, they're not investing as much as they could in their growth, which means that the value of my stocks won't grow as fast or as much as I would like them to. But you might be more focused on receiving passive income from your investments in dividend paying stocks. So it would make sense for you to invest in those companies, but make sure that you truly understand your own goals in the short term, medium term, and the long term. In the future, when I'm ready to retire, I might not be so focused on growth anymore. I might just want to receive passive income from my dividends or my stocks so that I can stay retired and not have to work, right? So in that case, I would then change my investment strategy to invest in more in dividend paying stocks than in growth stocks, right? Because I now care about passive income more than I care about the growth of the value of my companies. Okay, so now we know why stocks exist, how to buy them, and what kind of stocks to buy depending on our own goals. So now, what are the risks of investing in stocks? Hey guys, before we continue with this video, please remember to like this video below if you're enjoying it and learning something new. And remember to subscribe and hit the notification bell so that you always know when we publish new videos. And comment below what you've learned and what you would like to learn. Your engagement really helps the channel grow, and I appreciate all of your support. So thank you for being here, and let's get back to the video. There is one main risk to investing in stocks, and of course this is the same risk as investing in anything. You could lose the money you invest, which is called your principal, if your company loses value on the market and you sell your shares after the fact. A company's stock can lose value for many reasons. There could be a scandal, the company could be in legal trouble, or they could just run out of money because they can no longer make enough money from sales to cover their expenses. In a recession, we see many companies file for bankruptcy because they've run out of money and can no longer afford to keep the business running. In these cases, the money that you've invested, right, your principal, can be at risk of being lost. So what happens if a company goes into bankruptcy or goes out of business and has to liquidate its assets? Unfortunately, if you're a common stockholder, which you probably are if you're watching this video, then you are last in line to claim assets from a company that files for bankruptcy. Common shareholders have rights to a company's assets only after bondholders, preferred shareholders, and other debt holders are paid in full. In most cases, common shareholders don't get anything from a company that goes through the bankruptcy process. This is why you shouldn't invest in bankrupt companies. This can be a scary thought, right? But keep in mind that if you're invested in great companies that are far from going out of business, you shouldn't have much to worry about. Plus, you will most likely be able to see in advance if your company is nearing a liquidation event and have a chance to sell your shares on the market before the liquidation event occurs. If you have better information than other investors, then you have a chance to protect your money before a company goes through a liquidation process. So all of that might sound like a lot of risk for not much in return, but there is a lot of upside to common stocks. The main upside to common stock is that they usually outperform bonds and preferred stocks. This means that your money has a greater chance of growing when invested in common stocks than in bonds and preferred shares. Over the long term, common stocks outperform other investments, but in the short term, they are more exposed to volatility than other investments. So always keep in mind that it's normal for a stock's price to rise and fall in a single day, week, month, year, or even 2 years. Over the long term, however, the stock market has averaged a return of over 8% per year, which is much greater than saving your money in a bank or investing in other asset classes. I know that was a lot to cover in one video, but we've made it to the end. Congratulations for making it this far. You now understand what a stock is, why it exists, how to buy and sell stocks, the risks that come along with investing in stocks, as well as the potential upsides. So investing in stocks can be risky, but so long as you remember to practice the bull mentality, you give yourself the best chance at succeeding investing in the stock market. Remember that the bull mentality is that we know what we're investing in, we understand what we invest in, we believe in what we invest in, and we hold for the long term. That's how you build wealth in this country, and that's how you give yourself the best chance at growing your money investing in the stock market. So thank you for watching this video. I hope it's been informative, and I hope that this helps you get started investing in the stock market if you haven't already. And if you enjoyed this video, please remember to like this video, subscribe to the channel, and push the notification bell if you haven't already so that you always know when we've published a new video. And of course, if you have friends and family that might benefit from this video, please remember to share it with your network so that we can reach more investors that will benefit from investing in the stock market. And if you have more questions about stocks or want to share what you've learned, please comment below. And if you have requests for topics you'd like me to cover in the next videos, please comment below with your request. I enjoy chatting with you guys, and I always respond to every comment. So I look forward to your comments below, and I hope that you have a great day. Thank you again.